At the end of 2009, I had to report to clients in London for an investment trust that I used to manage. So in Jan 2010, I stood up in front of all these people and I said literally the exact following words. I said, I never thought in my entire career I would say the following words. Ladies and gentlemen, your fund is up 85% this year and I'm very, very sorry because the market was up 105%. And I said, but to give you 105%, I would have had to knowingly buy very, very bad businesses. And in good conscience, I can't do that. I think Uday Kotak once said to me that your DCF model may end in 10 years, my company won't. I remember when we tested nuclear devices in India. Yeah. And the next day or two, Pakistan tested one. And then the world imposed sanctions. I didn't know what sanctions meant. Now, of course, we are very familiar with sanctions. It seems like it's very, very intense at the moment. But if I look back objectively over time, over 15, 20 years, times have been very, very complex in the past. And I've been looking at businesses for a very long time. The one that I have been most impressed by is Hermes. You can't go into the store and buy the handbag. They create that aspirational, scarcity-led desire, right? Now, you could say, why do people buy $20,000 bags? I mean, I don't know. I'm very happy they do. It's one of those businesses that I think challenges every theory of economics and turns it on its head.
My guest today is Rukhshad Shroff. Rukhshad serendipitously entered the capital markets in the early 1990s before spending over a decade on the sell side at Jardine Fleming and JP Morgan. In 2003, Rukhshad moved to JP Morgan Asset Management in Hong Kong and spent the next 17 years managing their India funds. When he first began this role, those funds managed $250 million. At the peak, he would oversee over $11 billion in assets before he retired in 2020. Rukhshad is a thoughtful and eloquent speaker, and it was a privilege to have the opportunity to pick the mind of such a successful investor. Like many successful people, he's also disarmingly self-deprecating and goes out of his way to downplay his own incredible achievements. I had a wonderful time speaking with Rukhshad, particularly our discussion on the luxury sector. I hope you enjoyed the podcast as well. What the hell is going on in the world right now?
Nothing. Everything seems fine. What are you talking about? Well, the thing is, I can't make sense of everything, to be honest. And my only sort of recourse in times like these is twofold. One, I personally tend not to spend too much time trying to analyze macro, and particularly politics within macro. Now, I'm not saying it's not important. I'm just saying that I don't have the skill sets and the ability to change, on a dime overnight, right? And the second thing, actually, which is slightly more important, is, it seems like it's very, very intense at the moment. But if I look back objectively over time, over 15, 20 years, times have been very, very complex in the past. So take, for example, the Asian financial crisis. I lived through that as a professional analyst, and it seemed like like nothing like anything before. Right? Countries were defaulting, currencies were collapsing 20, 30, 40%. The Thai economy declined by 11%. Right? People were filing for bankruptcy. Markets were collapsing. Back then, it seemed like the most intense thing ever. Same thing post the dot-com bubble. Stocks were going down 40, 50, 80, 90, 100%. Yeah. Right? I remember when we tested nuclear devices in India. Yeah. And the next day or two, Pakistan tested one. Yeah. And then the world imposed sanctions. I didn't know what sanctions meant. Now, of course, we are very familiar with sanctions. So, I think if you look at the GFC, world-renowned financial firms and banks were disappearing overnight. Yeah. People were wondering if the HSBC ATM will dispense cash. Yeah. Right? So, it seems very intense now because human tendency is to forget about the past or sort of diminish the significance of the past. So that's my sort of 2 cents worth of what the hell is going on.
What are some of the more interesting or unusual business models you've come across, either in recent times or even just generally in your career?
Hermes. It's been around for more than 100 years. Yeah. It's family owned, it's family run. They're thinking about decades in the future. right? I mean, genuinely decades. How they treat their sort of stakeholders, their suppliers. The supplier of silk. Such a long-term orientation, and I'm just aligning my wagon to their engine and hopefully participating. It's one of those businesses that I think challenges every theory of economics and turns it on its head. Okay, if there is demand, produce more. They opt for scarcity. Now people get angry with this business model.
Right.
Okay. Now I'm not passing emotional judgment on this. If you don't like it, leave it. But it just fascinates me, right? Produce more? No way. If a product is selling like hotcakes, they stop the product. You can't go into the store and buy the handbag. They create that aspirational, scarcity-led desire, right? Now you could say, why do people buy $20,000 bags? I mean, I don't know. I'm very happy they do, right? But you're catering, to such a small market. Every other business is talking about expanding their TAM. So no, we're not expanding. We're going into the 0.01% of the population on the planet who is somehow interested in buying something that is beyond luxury. It doesn't make any rational sense, okay? But somehow it appeals to an emotion. So it's a psychological business model.
Yeah, absolutely.
Okay?
Yeah.
And they act cyclically, counterintuitively. I believe in COVID, they were the only European luxury company that did not take grant and subsidy from the government. They didn't take it. They said no. And in fact, they did the opposite. They went to their suppliers and said, are you having a problem? So yes, I am assuring you of offtake, 3-year offtake, and here's the cash up front. Just think about cementing that relationship, right? So it's a fascinating, and then on the other hand, they have products that are affordable. I mean, affordable to well-off people. But you don't have to spend $20,000 to become a customer of Hermes. You can spend $100 and buy a tie, right? But you're building that base of future aspirational customers, and it doesn't matter because the next generation of that customer may be interested. But they're thinking along those, genuinely along those timelines. So sometimes I can't even make sense of the economic rationale. It's exactly the opposite.
You would think that any store any company that makes you earn the right to buy their product. I mean, you would think most people would walk in a store and if they told no, you can't buy it because you haven't bought enough previously, they would tell them to stick that bag somewhere. But somehow it makes them want it more.
Yes. No, I'm sure there are people who are offended by that, okay? And what those people don't realize is that they weren't the target audience to begin with. I'm not the target audience, but I understand the nature of the model. But you're right, and Ferrari does that, Rolex does that. So that's a whole different cohort of companies, which is just interesting.
Right.
And then some companies just operate in a very, very narrow niche. We just produce one small component that is critically important to an aeroplane. No one's going to nickel and dime on this product because if that thing goes wrong, your 747 is parked for 2 weeks, right? So the pricing power that comes with that, and the at one level the irrelevance of the price, at another level the significance of the product, fascinating. Right?
You think is the single best business you've ever seen anywhere in the world?
Oh.
I mean, I know there's no actual answer, but don't want to make it too easy for you.
I think, I've been looking at businesses for a very long time. The one that I have been most impressed by is Hermes. That doesn't mean its stock is necessarily a buy because there could be valuation issues, but I think it's the most impressive an intriguing business to me. I think it has years and decades of longevity and duration. It's family run and there's a pride in the way they do things. Forget outsourcing, right? Every handbag is made by one person, only in France, right? The whole world went out to outsource, just in time and just all these things. They sit there with 12 billion euros of excess cash, and then do things when there's a dislocation, right?
It's interesting when you look at companies like this. what you said at the start, these businesses that somehow seem to fly in the face of everything that you're taught in your economics
yes.
seem to have something really good. Like they've understood something that most people haven't.
Yeah.
I mean, I think I remember there was one interview where I think it was the CEO or chairman of Amul, and he said, our goal is very simple. We want to pay our suppliers as much as we can and charge our customers as little as we can, which is the exact opposite of what you would think they want to do.
Yeah.
And somehow they seem to find something that nobody else can, and it really works.
Now, I don't know much about Amul, but it might be a cooperative as well. So, so profit may not be an important motive, but in our world of investing, we're investing in companies that are seeking to maximize long-term profit, right? And some of them are willing to compromise the short term. For years, Amazon did that, right? And some people penalized it, saying its numbers are all wrong. But just redeploying in the business, right? And creating optionality. So again, so many companies, Amazon being a good example, and I'm not an expert in Amazon, just try new things, and they fail. But AWS was a try, and it didn't fail, and the rest is now in the cash flow statement, right? So the willingness to try, fail, or make a mistake. You're not supposed to make a mistake, right? Because mistakes are penalized by the stock market. Again, flies in the face of, there's so many products have been launched, by big companies, and they fail. It's fine, right? You just make sure the failure is not existential. It doesn't bring down the whole house. So you have to calibrate and be, sensible. But that's where good management comes in. And it's endlessly interesting to me. So.
When you look at Hermes and you compare it to, I guess in some sense, the closest sort of publicly, widely followed company, which is LV. And when you sort of look at the two businesses, you would think that they're broadly the same business. Of course, they aren't.
Yes.
Because LV has a lot more going for it, and there's a lot more for business in terms of investing in other companies. But it's a question I sort of ask myself, that what is it that really, even at that level, why is it that one brand is seen as even more aspirational than the other? And when you look at those two businesses, how do you sort of think about that? Like, why is one better than the other, or what is one doing particularly better than the other?
I don't know about better or not. I think they've just chosen to do different things. So LV has had a history of acquisitions, very aggressive. LV spans the full spectrum of super luxury and just affordable luxury, right? So you can buy a bottle of champagne for 400 Hong Kong dollars, and a lot of people can afford it. But they also make the most expensive champagne in the world, right? Hermes has chosen not to do and go down that path, right? They don't want a portfolio with 100 different brands and product categories. They remain more focused, and there's no right or wrong. I mean, both are impressive companies, but you see, the narrative, which I mildly disagree with, is that LVMH is cheaper than Hermes as a stock, because one trades at 23 times and one trades at 46 times, right? Factually correct, but incomplete, I would humbly submit. If you look at the long-term growth sustainability of revenue, Hermes is more stable and higher over time. So you get a premium for that, in my view. The gross margins are grossly higher than LVMH because the product mix is different. Their operating margin is materially higher. And their returns on capital, which most people don't care about anymore, luckily, are almost twice as high. So therefore, your shortcut P multiple, one at 45, I'm just using rough call, and one at 22, those are not the same numbers, right? They both might be properly valued. They might be. So our tendency to take a shortcut and get a P multiple and just judge on that basis may not be the totality of the valuation effort that needs to be put in. So companies choose different strategies. I mean, Hermes hardly does any acquisition. I think nothing, right? both run very conservative balance sheets. But beyond a point, you can't, because you're driven by acquisition. And then acquisitions come with their own set of challenges. I mean, it's one thing to make an acquisition, and it's one thing to make an acquisition work. It's a very big difference. It's only a 4-letter word, but it's big. The history is very clear.
It's interesting. You've spoken about durability, and I think that's so interesting in the luxury space, because there's such a fine line between, pricing yourself to indicate how aspirational you are and pricing out the next generation of buyers. And I'll tell you why I bring that specific point up. I was listening to something about, they were comparing Ferrari and Rolls-Royce. Of course, different types of products, but of course, ultimately in the auto space. And Ferrari follows this sort of Hermes model of, you kind of have to earn the right to buy the products that we usually want to buy. You kind of have to...
And penalize if you do something bad.
Exactly. You can't, you can't do what you... Even though it's your car, you can't do what you want.
You can't just sell it off.
Exactly. You get blacklisted.
Yes.
On the flip side, so what's happened is ultimately the average Ferrari owner now is like 50-something, white, whatever, like a very specific subsection of society.
Yes.
On the flip side, Rolls-Royce has very much gone to the 20 or 30-something guy who's, sold his company or whatever, made money one way or the other.
Is that right?
And has really sort of understood the importance of not pricing out the next generation, where it's like, until I'm 65, I can't even think of buying this product. Like, if I've made money I bought Bitcoin when it was $300, like, I can buy the Rolls Royce today, no questions asked. I just want to get your thought on how you balance, that aspect of it when you look at a company like Hermes, and in the context of the durability of earnings.
When you look at multiple businesses, not only in luxury but anything, there are many different paths to success. And sometimes, small efforts may not work. But there's a big debate about how Netflix is evolving its business model. They've gone into, a paid advertising model, right? Oh, that's bad, right? But maybe it's not. For someone who can't afford $14, $8 is an affordable outcome. You watch some ads, right? But they've expanded their target market by doing so. Live events. In the past they didn't do live events, but now they do, and there is a demand for live events. Games, in the past they didn't. So Disney might say, no, I'm not going to do that, and I'm only going to do streaming content. I mean, it's entirely possible. So you have to look at what I don't know. All I'm trying to say is that there isn't one way to succeed, right? So going back to Hermes, I mean, it's entirely possible that there is some sort of secular decline. People don't want to spend so much money, even if they have the money. I'm not going to spend so much money on a handbag, right? The other thing that is interesting, going back to LV and the LV bag, to even a person who's not familiar with it, is obvious, because LV printed 1,000 times on one handbag. If you don't know what a Birkin bag looks like, you won't know. So it's not about displaying, it's about ownership, right? So it's appealing to a different thing. It's not, I'm so well off that I have an LV bag, look, but the other bag doesn't even show up, right? But you're right. I mean, strategies need to be viewed in the context of durability and duration. Not all of them succeed. Right?
Absolutely. Absolutely.
And these businesses have proven to be cyclical.
Are there particular businesses that you think have been remarkably outstanding businesses, and maybe they were outstanding for reasons beyond what people generally think of?
So, a lot that I've learned about investing, almost all of it, is through my years at JP Morgan Asset Management, where I was privileged to work there with some of the brightest people who've established very respectable processes. And I think process is important. So I'd like to steal a page out of that notebook. And we framed a business when we looked at it in sort of three buckets, right? So economics of the business, and I'll explain what that means, the duration, and then the governance, right? So economics is pretty straightforward. How profitable is the business, and how much growth runway does it have, right? And those in combination are a very powerful combination themselves, and they influence each other. And we can discuss that maybe with an example later. The second is duration, and I think this is one where people tend to diminish the importance of, because time is the exponent in the compounding formula, if you like, right? So if a business has an attractive economic outlook for 3 years, a steel business, that's one thing. If a business has an attractive outlook over 15 years, when you multiply that, then the outcomes are astronomical. So I think duration is very important, right? And the last is governance, which is important because as an investor, I want to participate in the economics and the duration. So I need to trust the management. Our interests need to be aligned, right? And all of this is overlaid by capital allocation, right? Management allocates capital. It impacts growth. It impacts profitability. It impacts duration. So, I'll give you 2 examples of the ideal business. For people in India, one of our largest holdings in our funds for 17 years was HDFC Bank, right? And more recently it has a more challenged outlook. But in 2003, the view was India will grow at 6, 7, 8%. India was very good at converting GDP growth into revenue and earnings growth, which was the attraction of India. HDFC Bank operated as a new bank, a tech-savvy, customer-oriented bank with competition from the public sector. So there was a lot of share to be had, and the pie was growing. When you combine those two, you get a very good outcome. So for a very long time, the business compounded at 15, 20, 25% per annum at attractive returns on equity, and were able to deploy more and more capital. For a very long time, HDFC Bank did not declare a dividend because their reinvestment opportunity was enormous, and the management, was aligned with shareholder interests. So that's one example. My other example more recently is Interactive Brokers. Now, not everyone may be familiar with the company, but you may have used the product. I don't know how pervasive Interactive Brokers is in India, but some people, I believe, are using it. And I think it's a phenomenal business. One difference between HDFC Bank and this business is, firstly, it's founder-led. The founder, who's almost 80 years old, has more than a 70% ownership of the business. He's semi-retired, but he attends the conference calls.
Petterfee, right?
Yes, Tom Petterfee. And his background comes from options and risk management and things. So this is a business where you're growing customers, you're growing geographies, you're growing access to markets. Customers are spending more or investing more. The ticket sizes are growing. More products, more countries, bigger, more profitability for, and the cost to service an incremental customer is borderline zero. The gross margin on this business, if I can't recall it, but is upwards of 75%, right? So there's no cost. They do a little bit of marketing, and they invest a lot in technology. They use capital as a competitive advantage. They keep excess capital. I think at last recall they had $12-13 billion of excess capital. Not because they're incompetent allocators of capital, but because they're giving customers comfort that, look, we're well capitalized. Nothing will go wrong. We don't mess around on asset liability mismatch, on duration risk. And I, as a customer, I'm a retail customer, but a hedge fund needs that comfort. A investment advisory business needs that comfort. High returns on capital, and they've got 1/10 the customers of Charles Schwab. So think of the runway for growth. So it's a great example, at least I think, of an attractive business. Now, valuations come in the way and muddy the picture somewhat, but we're talking about a business itself. I think this is what I would call a premium business. Economics, duration, and governance. When these three sort of overlap very significantly, they tend to influence each other. In my view, in a slightly multiplicative way, right? Those are very fascinating businesses, because then you're on some sort of flywheel of growth fueling profitability, fueling growth. Interactive Brokers is one. Right? Their scale benefits are constantly passed on to customers.
Correct.
Right? It's hard to compete with that. I think they offer access to 23 different countries, how do you compete with that?
Correct.
Right? 108 stock exchanges, or some such statistic, right?
Yeah.
And they have 3-4 million customers, and Schwab has 35-40 million. So, I mean, it's not very hard to see how you can do that.
When did you first invest in HDFC Bank?
So I was lucky that when I joined JP Morgan Asset Management in 2003, it was already a big part of the portfolio.
Right.
So all I had to do was nothing stupid and sell it or cut it down, right? For more often than not, it was almost 10% of the portfolio, and the limit was 10%.
Right.
But I kept it at that. So the conviction had to at least continue. It was already quite strong,
Right.
and the growth runway, and interacting with various components of management, for which I had access to, and I was lucky that access came because of the employer I worked for. Right, you could see how much runway for growth there was. Right? Why can't they be 5% market share of the Indian banking? Now we crossed that milestone sometime, but why can't they be 8% or 10%? Right? And I think the sense I got about how much they thought about risk, because banking is a 10x levered business.
Right.
Every mistake you made is a magnified, often existential mistake. Right? And that's what leverage does. And without leverage, there's no banking business. But the consistency of just doing the right thing thoughtfully, without thinking about only the next quarter. You have a long-term framework, even though it is professionally managed bank. Right? And I think in that same vein, I think Kotak Bank was a very significant example of a large bank that we had an investment in. And there the difference was Mr. Kotak's name was on the door. Right, every day, as he reminded me, and it was an important lesson.
I would imagine you had meaningful interactions with the top managements at both.
Yes.
What were your key takeaways from those interactions? What did you think of them? Every time you met them, did it just solidify your view that these are people I want to be in business with?
Yes, all of the above. But I think the first thing was they understood the opportunity ahead of them.
Yeah.
And they didn't need to be impatient and worry about this quarter or the next or 6 months or 12 months. They thought about and operated with a very long-term time frame. I think Uday Kotak once said to me that your DCF model may end in 10 years, my company won't. And that's a brilliant insight, yet again. And so that's the kind of, so if there's a product where there is irrational lending, there's unprofitable activity, right? Walk away from it. You don't need to participate in a high risk, low return environment, right? But the opportunity set is so large, you don't have to make compromises. And so understanding the opportunity, an acute understanding of risk, extrapolated over a long period of time, is just a compounding magical outcome. And I think they've proven it.
It's interesting in both these examples. I think you touched on it. A major thing is, I don't think any of the people, I mean, if I'm talking about Uday Kotak and Aditya Puri, I don't think any of them went to work worrying that they're not going to have a job the next day. And I think that was such a massive advantage they had over most other peers.
Yes.
And I think of, in today's context, like Jamie Dimon. Nobody's firing Jamie Dimon.
Yeah, absolutely not.
And so, have there been cases that, whether in banking or otherwise, where you've seen that competitive advantages have been things that, things like this, that they don't show up on a balance sheet?
Yeah.
There's no quantification of the value of that.
Yes, I mean, culture is one, right? A lot of people talk about putting customers first. But, do you really? Or is it one of these things that you print on your annual report, talk about at town halls, and then have no idea what it means, right? How you treat customers, but how you treat all stakeholders. Your employees are your stakeholders, right? I think Kotak Bank is a very good example. The senior management has worked there not for years, but for decades, as a team together, and they all embrace that same culture of risk awareness, of thinking about the long term, giving value to customers. All of these are, they're not very complicated, but they can often very easily be ignored, or they get lost in the momentum. And I think, they do get sort of, how do you put that? How do you put longevity of management into your DCF model? Now you can expand the model and say, you know what, Uday Kotak will be, and now of course that has changed somewhat, but it's not like he's coming there to work for this year's bonus and his stock options, right? Even someone like Jamie Dimon, and I was privileged to work under his leadership for a very long time, that culture pervaded the whole firm. It trickled down. So just do the right thing. Be honest. Own up to mistakes. Mistakes get made. Take responsibility. Fix it. Right. These are not all quantifiable things. So I think they come with a little bit of experience, a little bit of touch and feel.
There's actually a very specific aspect of your holding of these two. Now, if you've owned them for multiple years, you own them through the late 90s, 2000s, seen, boom markets. And suddenly 2007, 8 rolls around. And you kind of think to yourself, okay, things are going wrong in America, but India's generally fine. And suddenly HDFC Bank is down, 40, 50, 60%.
Yeah.
What did that experience and living through that teach you about investing through unpredictability and having the conviction to hold on to something even when every bone in your body is trying to get you to move away?
Yeah. I'll give you a specific example of that whole time period. But, once you've built conviction in the management and in the business, and we spend time building conviction, and you don't want to reinforce biases, because that's the flip side of, conviction can very easily become a bias, right? And it's a human tendency. I mean, it's just, we're all prone to this. I think you then, at that point, have to sort of disaggregate the conviction. Now, is the stock down because the market is down 50%? Or is the stock down because the earnings are down 50%? Right? So these many businesses were hit. The stock prices were hit. The businesses were not. Well, there was some impact because all businesses are cyclical. And then, it was a bit unfortunate that it doesn't add alpha at that point because, the market's now being indiscriminate. Right? So you have to sort of grit your teeth and sit through that. That's where conviction comes in. Right? In the rebound, of 2009. So I remember this very, very painfully. So between, I think, March of 2009 and May of 2009, the MSCI India index in US dollars went up about 98%. I didn't participate in that. I had good quality companies. So other companies went up 300%. I owned these businesses, continued, but they underperformed the market. And one of the sterling moments of my rather patchy career was, so 2009 unfolded. At the end of 2009, I had to report to clients in London for an investment trust that I used to manage. So in Jan 2010, I stood up in front of all these people, and I said literally the exact following words. I said, I never thought in my entire career I would say the following words. Ladies and gentlemen, your fund is up 85% this year, and I'm very, very sorry. Because the market was up 105%. And I said, but to give you 105%, I would have had to knowingly buy very, very bad businesses. And in good conscience, I can't do that. I mean, I'm charging a fee. I can't knowingly buy bad companies. I mean, I might end up buying a bad company because that's the nature of the probability outcomes. But I can't knowingly do that. But you sit through these things. And in some cases, I've had this conversation with Mr. Kotak once. Why do you hold so much capital? Way more capitalized than you need to be. He says, because one day something will go wrong, and I need liquidity and capital to survive, if not to profit from it. I can make an acquisition when everyone else is trying to scramble for capital. Yeah. So, that can become a competitive advantage. Just as I said for Interactive Brokers, I'm sure if they paid out $16 billion of excess capital, or whatever it is, 13 billion, right? The short-term reaction in the market will be, yay, we got, a huge dividend payout or a buyback or whatever. But he's thinking about the next 5, 10, 15 years. Like, I want to attract a wider cohort of clients, not just mom and pop retail investors. I want to attract the platform companies, the big hedge funds, and whatever. So to meet that requirement, you need to be well capitalized, and that comes at a cost.
You said something incredibly interesting right now, which is that everything ultimately everything is a cycle. Is it? Do you really believe that?
So, the short answer is yes. I think I start with that premise. Okay, because to a large extent I believe it. There might be exceptions, but I think those are few and far between. And when I say everything is cyclical, it sounds like some sort of ridiculous sweeping statement that I haven't put much thought into, which may be the case. But no, but I think if you think about it, the reason it sounds slightly silly is because perhaps the definition of cyclicality is very narrow. Now, if I said to you steel companies are cyclical, it's very difficult to argue with that, right? Because the cycle may show up in the profitability of a steel business. But, you could see the cyclicality in the raw material price of something. People will consume tea in India forever, but the price of tea may fluctuate, right? So your margins can fluctuate. You may be using a very important chemical that might fluctuate. Your user industry, paints was considered to be secular growth story in India, right? But who's consuming paints? People who are painting their homes, or builders who are painting their homes. The user industry is cyclical. The interest rate matters. The price of property matters. In the industrial uses for cars, the demand for cars is cyclical. So there can be derived cyclicality, right? And cyclicality could also mean that I used to grow at 25%, my top line. Now I grow at 12%. Right? So take Hermes as an example, this ultra-luxury business. It used to grow at 20-25% top line. Recently, it's grown at 10-12%. But its competitors have seen revenue decline. They were all considered secular businesses catering to the ultra-rich. But the ultra-rich also sometimes pull back, right? So I think that, I'll put the question back to you. Can you point to any businesses that you believe are completely immune to cyclicality? Right? Across the world, right? Even the big Mag 7 companies, you see, there is cyclicality. There may be even underlying, there may be structural changes. 5 years ago, these were capital light businesses, and that was their reason for commanding a huge valuation premium. Today, the 5 of them are going to spend $700 billion in the next 12 months, right? What happened? So, that may be secular, or it may be a cycle. We don't know yet, right? So I just take the view that everything is cyclical, and if you don't agree, then you just haven't found the cyclicality yet.
You're going to learn a very expensive lesson.
Yes. And actually, that's a very important point. If you assume there is cyclicality embedded somewhere in the business, I think it's a good risk mitigating tool when you're thinking about valuation. If you think a business is going to grow like this, you will value it in a very, very optimistic sort of linear fashion, which may or may not, manifest itself. But if you think about it like this, in waves, in cyclical bouts, I think you might have some element of cushion built into valuation, which may minimize your investment risk.
If I, just as an example, take Unilever, I'm not talking about HUL, I'm saying Unilever globally.
Yeah.
Now, if you think about the nature of products they have, everybody's eating ice cream, everybody's using things in their day-to-day life. So in theory, a business like that should be as close to immune to cyclicality as any other business. But now that business has had lots of issues for a number of years now, so would you classify that as some form of cyclicality, or would you classify it as, management or whoever else just hasn't done their job properly and hasn't innovated when they needed to, or whatever other issues they may have? So how do you, my question ultimately is, how do you distinguish between cyclicality in cases like that and just somebody not, doing the best job that they can?
Or third, if I might just add, is there a secular change that is underway?
Right.
And it's just appearing to be cyclical. Now, I'm not an expert on Unilever, but I mean, I know the company, obviously. It's just had top-line issues, top-line growth, because a large part of their business comes from the developed world. And yeah, everyone's eating ice creams, but many people have stopped eating ice cream. Okay, that may be a health awareness. It may be just awareness, or it may be owing to certain products, like GLP-1 medication has an impact. Is that permanent? Is that temporary? The answer is we don't know for sure. Okay. Now there may be management issues in many companies where in the hands of a different set of management personnel, could there be a different outcome? Right? And in America, that you can test because there's very low tolerance for underperformance, and there's mechanisms, right, for sort of hostile behavior and activist investors and so on and so forth. In other parts of the world, it's less so. But I think it's a good question, and the answer is that it's quite hard to know for sure. And a lot of businesses are going through that right now. Alcohol companies, are they going through secular decline of alcohol consumption or not? Right? You have software companies in the US getting their face bashed in. Is that just an overreaction to the impact of AI, or is this the new world? And it's I think it's actually quite hard to tell, but it's worth pursuing, because if you get it right, either way, there might be huge opportunities, because stocks could still go to zero and be made completely redundant, or you're getting stocks at 12, 13, 14% free cash flow yield, and the market is handing you easy money. So I don't know.
I apologize in advance, but I keep coming back to the financial crisis, and because somebody who was like right in the thick of it.
Yes.
Because and you had the advantage that you were looking at India, but you were sitting in Hong Kong, and you were part of a American but ultimately global institution.
Yes.
You kind of had so many different perspectives, and I'm trying to think think of the day Lehman Brothers goes out of business, or whatever you want to, crashes, or whatever you want to call it. I'm imagining you're a fund manager on that day. How do you make sense of it? How do you this is unpredictability, times 10. How do you live and how do you deal with a world like that?
It's a unique balance, I think, of taking one day at a time, but also trying to take a longer term view. Now, you take a longer term view on a business that doesn't exist, it's a bit of a problem, right? So you hope that the rigor of analysis counts for something, right? Now, I think my job was much easier than the guy analyzing Merrill Lynch, in the US, because it was a binary outcome. I didn't think HDFC Bank would go out of business. I didn't think a lot of, and to be fair, it was a global financial crisis. We've called it GFC, but it was very concentrated in certain parts of the world, right? And of course that then spills over, because there is contagion, and there is leverage, and there is liquidity, and there is a globalized financial markets. But I think India was relatively, immune, certainly not in the eye of the storm. So that my job was a little easier. But I did something very interesting. In preparation for that meeting in London, where I had to apologize for an 85% return, in preparation for that, and in my firm belief that the human mind forgets, as we talked about earlier, because this is unprecedented, but there have been multiple unprecedented moments. So I got someone to do an exercise for me. So from, I think, the 1st of October 2008 to the 31st of March 2009, a slightly arbitrary period I chose, but it was the eye of the storm. So can you just jot down every single headline on the front page of the Financial Times newspaper as a proxy for global finance? Okay? Just the headline. And the physical newspaper will have 3 or 4 headline stories. And just collate them for me. So it's a thick document of 100 odd pages. And I went through it. And I thought, oh my God, having just been through it, so it wasn't distant memory, okay? It was 9 months ago, the amount that I had forgotten, being a participant in the situation, it's unreal, right? Of course, we think of the big ones, Lehman and whatever. So many other things had happened, right? So it was a fantastic exercise. I wish I had kept a real-time diary. Okay, now it's obviously it's too late. But imagine if you had kept a real-time diary of events, how you feel, how you're coping. I think it would be an invaluable thing.
It's so interesting. I think some of that is also just a human coping mechanism, right? It's like dealing with trauma. You kind of your brain forces itself to forget.
Yeah, and also I think at some level, you start to hopefully you start to differentiate. What can you control and what is out of your control, and focus on the former and just deal with the latter. Now it's easier said than done, but I can't cope with or influence what the market in the US will do tonight. Okay, but I can look at my portfolio and see where there might be vulnerabilities. Is someone over leveraged? Is there a lot of dollar debt? And have I missed something in the course of selecting this stock? Is something very attractive now on offer? You can rejig the portfolio. But you have to keep your cool when everything else is.
And all about others around you. What's that line? From fantastic.
Yes,
fantastic.
It's a Kipling line.
All others are losing their heads. Yes.
Then you can be a man.
Are there parallels between anything that you see today and things that you saw during those periods that sort of ring an alarm bell somewhere in your mind, or do you think that there's something particularly unique about the situation we're in right now?
So we haven't used the B word yet, but if you're insinuating that we might be in a bubble, I mean there is an argument to be made in that context. Certainly, the financial media is rampant with that. My answer is very often I don't know. I think it's a very useful balance to conviction. It's okay to not know, but I think the dot-com bubble. When it occurred, I was an analyst and a strategist on the sell side. So I wasn't actually managing other people's money, which makes life easier because you can just write a report. I'm downgrading the tech sector, and just downgrade it, it's over. But if you have to sell 20% of your portfolio after it's down 30%, this is a whole different ball game. But I think the one difference was that in the dot-com bubble, which we now know was properly a bubble, because hindsight is a very useful thing in identifying bubbles, it felt maniacal. So the valuations of big companies around the world, including in India, were on the border of absurd, 100, 200 times earnings, right? A lot of companies, a lot of big businesses didn't have any earnings at all. So that, you're pumping up eventually what proved to be utter nonsense. Today, you've got some of the best companies in the world participating in this what may or may not be a bubble, and they're on 25, 27 times earnings, right? Now, I also, having read a lot about previous bubbles, going back in history, bubbles are not all the same. They might manifest in different places. So, for example, in 2000, the bubble manifested in valuations, in my view. Today, maybe the bubble is manifesting in capex. Do we really need $750 billion? Now, will some of this capex and capital get written down? It's very possible. Some people would argue quite likely, right? So it's not in the multiple, it's in the earnings sustainability and the capital. I'll give you an example. So I had to write a weekly back in my strategy days. Every Friday evening, I would write a weekly. And one of the inputs to that weekly was, what are the best and worst performing stocks? And so one Friday afternoon, IDBI was the best performing stock. They were in the middle of the tech bubble. And I thought, this is a very strange name. So, it was up 36% or something, now from memory, in a week. Okay. So I said, let me, check what happened in IDBI. So a few days before that, sometime during the week, there was a headline story in one of the pink newspapers. May not even have been true, okay? But the story was, this is true. The story was IDBI, which is not a tech stock, is rumored, so it's not even a fact, it's a rumor, to be thinking about employing a consultant to advise them on their .com strategy. Okay? This is a stodgy lender. It wasn't even a bank back then. And it's the best performing stock in some universe of 100 stocks. And I thought, this sounds pretty, bubbly to me in real time. In some stocks, maybe it happens even today, and I'm not entirely sure. Maybe the bubble is happening in private credit, and it's not manifesting, in the public space. And I'm not an expert in all of these subcomponents, so I don't know. But I do know, I went through my own personal experience in the bubble, where I was sitting in my desk and the phone rang, and I was summoned to the reception. And some lady said, someone's come to see you. I said, oh, I don't have any appointment. So this man came and said, Rukhshad Shroff? I said, yes. He said, can I have 10 minutes of your time? I said, sure. Sorry, who are you? So no, I'm, I have a .com startup, and I've just got my first round of private equity or venture funding. And I said, okay, and said, I want to make you an offer. I've read your content. Back then I published research and it would be put in the newspaper without any regard for copyright or anything like that. So I said, actually, just not to mislead you, I'm not interested at all. I'm very happy in my current job and I have no interest in leaving. I said, but just out of curiosity, what is it? He said, no, we've read your content and it's very interesting. So we will pay you 16 rupees a word.
Okay.
I said, that's for short words and long words? Or because the is 16 rupees and valuation is 16 rupees. So he said, yes. I said, not my place to advise you, but maybe you shouldn't be spending your capital like this. And I politely declined and I had to leave. He said, okay, I understand. Perhaps you can write under a pseudonym and I'll pay you 8 rupees. I said, I think this conversation's over. But this was the kind of nonsense that was going on. And I'm sure in some pockets of the world it's happening. But on balance, to me, this doesn't feel as bubbly as 2000 felt.
You're right. I think there are, I guess we don't see it as much in India, but there's a lot of question marks today on private credit in the US, and there's a lot of people who believe that will be somehow the epicenter of any potential.
But sorry, I'll just add one other perspective. Having said that, if you look at, the sort of ingredients for a bubble, as some people have, articulated, there is a new technology. It's going to change the world. Right? It's been written about and people are backing it. There's an easy availability of capital to that technology. Now companies are raising debt. Right. I think I read that Alphabet was planning to raise a 100-year bond. I'm very interested to see whether that gets subscribed.
In Switzerland?
In the UK and in Switzerland. Yeah. So they raised $20 billion sometime this week or last week. They were planning to raise 15. They got 20. Mind you, this was a capital light business model of just a few years ago. And they got demand in excess of 100 billion. So easy availability of capital, right? In some pockets, disregard for valuation, right? But also, in this time around, I feel there's another big difference, which is there are rolling bubbles and deflation of these bubbles. Oracle went up, came down. You look at the Mag 7 performance over 2025. In 2000, every single stock went up. Here, half of them have underperformed the S&P, right? Yeah. So it doesn't look insanely sort of overbought or overvalued. So I think we're in a rolling bubble situation, right? The IPO activity is not off the charts. That's another, but it's part of the capital cycle. We haven't seen a whole bunch of frauds, but that happens after the bubble after the thing rolls over. So there are many things that make it different, but yet there is self-correcting mechanisms underway, it seems to me.
Are we on course, do you think, to see many more GEs? And I'll tell you what I mean by that.
What's a GE?
As in general.
Oh, yeah, sorry.
Yeah. Sorry, I should have. No, it's unfair to just drop that on you. So I'll tell you what I mean by that. I see these, iconic companies that had incredible, several decades in many cases, But you look at them today and you can't help but think that, the best days are behind them. And I'm not saying they go out of business tomorrow, but, they've kind of lost that luster and it's very difficult to get it back. And I'm not saying that this is the case, but I'm just using them as potential examples. You think of like Coke, and you think of Disney, and you think of Nike, and these are all companies that have had incredibly storied pasts, have so many things going for them even today, but you can't help but think that, is there a structural shift? Have they kind of, sort of lost that shine? Do you think that there are many more General Electrics? We just don't know it yet?
So firstly, I am not an expert on General Electric, but I would also say, having dismissed that lack of expertise and then continuing shamelessly, is that General Electric went through that tough time, and I think it's come out now. So it's split up into a number of companies, and they're all very competitive and compelling businesses, from what I understand, or I'm given to understand. I've not looked at it. It falls into my sort of I may not know pile. But where I would agree with you, in the same way that I said everything is cyclical, start with that premise. I would start with the premise that lifespans of all companies have been shrinking and will continue to shrink. And in some cases, companies might die. In some cases, there's life after death. You come back, right? So I think GE has come back in a new form, right? And while it was going through its own issues, they were pretty existential, and that cycle is happening more and more frequently now. So it was only 2 or 3 years ago where Netflix was struggling. Today, it's extremely profitable, right? And Disney is the struggling one, and the streaming wars are killing everyone except Netflix. So 9 months ago, Google was the write-off in the AI space. 9 months ago. Today, it's the poster child of excellence. This is not even a long time frame. So I think there is a risk that lifespans shorten for the companies. There is also an opportunity for companies to pivot and sort of regain their footing, if you like. And that's where perhaps management will make a big difference, right? But again, it is an uncertain world, and there's very, very rapidly evolving technologies that no one has fully understood. I mean, we've been using the internet for 25 years, but in 2020, if someone said, you'll have this device that you can call a car and stream 1 million songs, you'd think I was completely insane, right? And here we are. So it will evolve so fast that it's almost unimaginable. That's with all new technologies, right? That's the history of technology. So, companies will go away.
And maybe just as investors, that's not necessarily a bad thing, right?
No.
That's how opportunities arise for you to begin with.
And also there's this distinction between the technology surviving and the companies not. So when the automobile was invented, there may have been dozens of auto companies in America. The automobile survived. The companies did not. The internet companies did not survive. The internet does and provides a valuable service to 8 billion people. So the railway companies consolidated into 2, but it was an invention and a development that was very useful. So that's how things will happen. I suspect, if history is any guide.
If you could go back and talk to your 22, 25-year-old self, and you could just give him one short message other than a stock tip.
Yes. Buy Bitcoin at one.
What would be that sort of one line or brief word of advice that you would give him that you think would be most important to stand him in good stead over a 30, 40, 50-year career?
I would say constantly find ways to reinvest in yourself, in your own growth. Now, I've done it, but everyone can do more, right? And it's one of those non-financial compounding things, right? And in your education, formal or otherwise, learn new things. Say yes more often than no. Certainly in the early, I'm assuming I'm 22 years old. Trust people, and partner with people in a sense of not trying to extract but contribute. Shift that mindset. What am I going to get from this? No. What can you add to it? Try and make it a win-win rather than an extractive situation. Invest in your own communication skills. I wish I could be better. And very often, the opportunity presents itself, right? And we tend to be distracted and say, I'm quite busy. And all of these things, I think, compound, right? And the more you have, they compound with each other. So I think it becomes exponential then in terms of outcome. So just, keep learning, feed a curiosity. Don't think something's a waste of time. Don't feel some body is a waste of time. And just be generous of spirit, I think. So I think I've tried to do many of these, and I feel I should have done more. And all of them are somewhat infinite, right? I think that's it.
That's as pleasant and warm a note on which to end
okay,
as I can think of.
And buy Bitcoin. Before it was invented. But
I think that's fantastic advice, right? That in some ways, and especially I feel like in this world, those may be the things that differentiate the men from the boys more than anything else. And Rukhshad, this was absolutely fantastic.
No, it's been my pleasure. You made me think about things that I don't normally sit and think about. Now I'll go through these rabbit holes on the way back home. Yeah, excellent.
No, absolutely. Genuinely, thank you so much.
No, it's my pleasure.
And thank you for making the hike, and it was wonderful having you on.
It's good fun. Thank you.